Welcome to the August 15th, 2022 advanced report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, the weekly fast-paced tour of the global financial markets. Be sure to subscribe and share the link with your friends that can benefit from advice from McGowan Group Asset Management, a team of 10 that cares, serving affluent families and taking care of them each day with a devotion to excellence in service and helping our clients earn superior profits over time. What we're going to do today, we're going to go through the S&P, but I wanted to cover something big this week. Inflation, just for the month of July, just the month of July, the headline said, oh, inflation was 8.5%. Okay, that's trailing 12 months. Month of July, inflation was 0. Producer inflation was actually deflation, minus 0.5%. That means that you've got the first sign that inflation is coming down, and I've got the updated figures on what the Federal Reserve is going to do and when, likely after that data. Well, S&P 500 stands right now at about a minus 10.5% for the year. It was a full-fledged bear market, and that was building in a recession. You've heard a lot of talk about recession. Well, this builds in a modest or moderate recession. That's exactly what you see during Fed tightening and in preparation for a recession. But did it happen in the second quarter? It did not. And I'm going to cover why the S&P 500 is up 16% from this low. And we'll mention a few of the asset classes that we're using to actually take advantage of this very pessimistic sell-off that climaxed on June 15th. That was the date of the Fed meeting. That was the Fed meltdown when they said, we'll do whatever it takes to kill inflation. And apparently the interpretation was they might kill the economy too. But that's a nice bounce since then. And what led to it? This is the earnings grid for the S&P 500. Energy companies, by the way, tripled earnings. Overall, S&P 500 companies had 8.7% profit growth. That was slightly lower than the trailing 12 months on inflation, by the way. Sales growth was 15%, and that means that after inflation, sales growth was 6% real growth. That's actually a pretty good report. And we had reported as the first earnings came out, there's like 3/4 of the companies were better than expected. Well, that means that it's not actually a recession. If we look at what's happening with companies in the overall economy, stealth recession is where inflation exceeds the dollar growth in the economy, which happened in the first half of the year. So you met the official definition of recession, real GDP growth negative for 2 quarters in a row, but you still had dollar expansion, and companies actually did pretty well over and above the inflation. Now, here we look at the Fed calendar. So this is the Fed funds rate. This is what's likely to happen based upon the learned economists at Bloomberg, and our team of 10 has assembled the charts and graphs for you to give you guidance. September 21st, Federal Reserve expected to go from 2.5% to 3%. Then November, expected to go to 3 1/3. They don't usually move in thirds, so that's like 3 1/4, maybe 3 1/2. Then they start to come back down in 2023. So the cost of capital, overnight bank lending rate, that's the base cost of capital. Companies pay more than that, but that's where the premium comes in. And this says the markets were fine. We're like, we can digest that. The cost of capital goes up. We now have a better idea of what the Fed needs to do or will do in the tightening cycle. And you've heard relentlessly, recession, inflation, supply chain, all of these negative headlines climaxed in June, and we're bringing you what the real data is. Here's the interest rate on the 10-year Treasury. Now, it could be institutions are building in a recession or a contraction that forces the Fed to lower rates. Well, 3.5 was the peak in June of the 10-year Treasury, which means mortgage rates went to 6. Now mortgage rates briefly dropped below 5, and you can see at 2.8, you're down about 0.75% on the 10-year. This is the T-bill moving exactly to 2.5%, which is the Fed target for overnight bank lending rate. That number will go to 3. You can already get, by the way, for the really conservative money, you can get over 3% on a 1-year Treasury. That rate went as high as 3.3 just for a 1-year Treasury. That's better than the money market. Money market will start to catch up, but about 1.5% for the safe money on, say, the Vanguard money market. We put those in a non-managed account so you don't have to pay a cost for the ultra-safe money that would normally be in CDs or cash or something like that. Okay, what is this? Asset categories. This is important. This category of an asset is not an asset class. Asset classes go in here, but the reason I bring up categories, it's what an asset is supposed to do for you. And I'm going to give you a neutral balance here. We want to be good at 4 categories. And that's what the investment committee here at McGowan Group Asset Management does each week when we meet. Growth and innovation. I believe it'll be a good time to add to that in December because of tax loss selling. You could potentially catch a nice bounce from that. Safety and income. I mentioned the Treasury Bonds. Also, there are good choices in this category that can give you a yield on your tactical safety. High cash flow. That's global lending. Think of a bank portfolio, loans and bonds, you earn interest every day, and if you can buy it at a discount, that's even better. Growth with income, that's dividend companies, like the medical dividends or the pipelines fit in this category. So, if you're neutral at about 1/4 each, you've got tactical safety, which we put to work in June. Now you could start to see a more sophisticated approach to an allocation strategy that has a permanent devotion to 4 great asset categories that pay real cash flow. I'm Spencer McGowan, President, McGowan Group Asset Management. Thank you for tuning in. Be sure to subscribe, and each week we'll be right here with an update on the financial news and what we're doing about it. Thank you for tuning in to NetWorth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, NetWorth Radio, and NetWorthRadio.com. The NetWorth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the NetWorth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.